All right, so good morning, Facebook, or whatever other social media platform you happen to be watching this on. And of course, some of you will see it in our YouTube channel or in subsequent emails, etc. But as you've probably gotten accustomed to, I'll backtrack here in a second. We do a live video after we put a blog post out, and a lot of you get that via email anyway. But now, allow me to digress. The audio on this video is going to be borderline atrocious because the microphone in the camera is actually what's picking me up. The microphone that I would normally use and recommend to all of my colleagues that do good video work, that you have to have good audio, but the last time I did this, I left the microphone on, killed the battery, and now I need to go replace the battery. So, apologies for the totally inadequate and inappropriate video for how we would typically do these videos. In any case, our blog post is out, and actually it is mortgage-related content this time, which I know is unlike us, but every now and then we speak on a subject that actually has some relevancy to what we do all day, every day. And this post, we do this twice a month, happens to be about the differences between 15 and 30-year mortgages, or why you should choose one versus the other, whether you're refinancing or purchasing a home, what the benefits and deficits are. Like 15-year loans have lower interest rates. They are obviously forcing you to build up that equity. You're bound to that higher payment, so you're building the equity faster. This may be your forever home. You want to get it paid off and be free of a housing expense as soon as possible. That would help facilitate that. And then 30-year mortgages, obviously, if the cash flow is something that you're interested in, your monthly cash flow, they're going to have lower monthly payments. It's going to give you the opportunity to put those dollars elsewhere, maybe into retirement. And obviously, you're not bound to the minimum payment. If you want to make 15-year payments on a 30-year loan, you're certainly welcome to do that. There's no such thing as a prepayment penalty on owner-occupied residential mortgages any longer. They would be considered predatory and went the way of the dodo some time ago. And then I'll tell you personally how I view it. I am certainly big on the cash flow. Oh, thank you, Steve. Yes, the audio is good, but my context is rambling. I appreciate that, and thank you, Erica, as well. And yes, I know you guys can hear me and you can understand what I'm saying. The audio quality just isn't as good as when it is with the lavalier microphones. In any case, my personal take on 15 versus 30-year mortgages. One, right now, interest rates are so stupid low that there really isn't a big gap between 15 and 30-year loans. We're not talking a decade ago where you might have seen a 7% 30-year loan, it would have been longer than that, and a 5% 15-year loan. So the gap just isn't so significant. So the interest savings is there, no question, but it's not as big as it was in yesteryear, yesterdecade, when we really weighed that thing. The monthly cash flow is a big deal to me for a couple of reasons. I don't want to be bound to the higher payment. I may need that cash flow one month. The transmission falls out of my car and I need that money to replace it. One example. The other thing is that my financial planners earn me a pretty solid rate of return. Now, my risk tolerance might be a little higher than most of you out there for my investments, or than many of you out there. I am going to admit that I am getting older and my risk tolerance isn't as high as it once was for, being able to lose everything and have time to build it back up, for example. But those guys are earning me, 15, 20, one of them even like 29% return in 2019. 2020 has been a little volatile, obviously. But let's even be conservative and call it 10%. I'm borrowing somebody else's money at 2, 2.5, 3. Yeah, 3 would be a fairly high interest rate today on a 30-year loan. And the financial planner is going to conservatively get me a 10% return. Now, of course, the house appreciates no matter at the exact same rate, no matter what I owe on it. So there's no benefit in having the additional equity there. So if I'm trying to get myself closer to retirement, if I'm trying to get myself closer to paying that home off, I'm really more inclined to take a 30-year loan, take the difference in that payment, give it to my financial planner, earn my 10% return on it. And if I decide in 15 years, as I've built up those monies, that I want to pay off my home, then so be it. I can liquidate that asset and use it to pay off my home if that's what my heart desires. So I think it just provides a little more flexibility. And it certainly provides a greater rate of return. This is what people in the mortgage industry would refer to as leveraging that debt and leveraging good debt. So positive debt. So that's my personal take on it. If you want to read the rest of the blog post, certainly feel free. If you want to find out more information or read other blog posts or whatever your heart desires when it comes to data about the Core Finance Group, you can text CORE to 63566 and it'll ping you back that stuff. Other than that, that's basically how we're rolling these days. Chilly morning, a little bit of snow in Denver today. So for those of you that are local, stay warm. Give yourself a few extra minutes to clean that off the car if need be. And I guess we'll see you guys next time. Hope you guys all have a great day.